Welcome back to Protecting and Preserving Wealth. I'm John Gay. I'm joined by Bruce Hosler, Alex Corey, and Jason Hosler of Hosler Wealth Management. Today is part 4 in our series on estate and legacy planning. And today we're talking about strategies for leaving your assets tax-advantaged and tax-free. So we're going to start with the man who wrote the book on moving to tax-free, Bruce Hosler. Welcome, everybody.
Thank you, John. Welcome, everyone. We're glad to have you on our podcast today. This is a great topic, strategies for leaving your assets both tax-advantaged and tax-free. And I want to start off with the definition between the two of those. So this planning is dependent kind of on where the asset is positioned and kind of how it's titled. So positioning means the type of account that you've left your money in. Taxable, tax-deferred, tax-free. Those are the 3 primary buckets, but there's some kind of assets that are also outside of that, really. And it can also have to do with how you've held the assets. Now, Arizona is a community property state. So are you holding that in community property with rights of survivorship so you can get a double step up? You can provide that full step up if you make sure that you've titled it right. Now, let's define tax advantage. Jason, I'm going to start with you. What are the assets that we're going to consider tax advantage? They're not tax-free, they're not taxable, they're in between there.
So if you're starting, of course, with your taxable, you're subject to tax on any of the interest, dividends, capital gains that you would have in the current year. The step of tax advantage is for most retirement accounts like IRAs, 401ks, 403bs, where generally you're going to get a deduction for your contribution because the government's encouraging you to save for retirement. While you have those assets invested and they're earning interest, dividends, capital gains, you don't pay tax on them. That tax is deferred. It's deferred until you take a withdrawal. So then finally, when you're retired on the back end and you are taking withdrawals from those types of accounts, you recognize that as ordinary income and it's taxed like W-2 wages. But your accounts being able to grow without paying taxes all those years, that's an advantage for sure.
I want to address that concept of ordinary income, folks, because that ordinary income is coming in at your highest marginal rate. If you've got all your other income and you add additional ordinary income, it's coming in at the highest rate that you're going to have. So we want to be careful with items that are taxed as ordinary income. Alex, I want to talk to you, or I want you to talk to our listeners today. The next bucket we want to talk about for this whole concept of strategies of leaving assets is tax-free assets. So talk to the folks about what tax-free is, and we're talking specifically tax-free from income tax, but talk to them about the characteristics of those type of assets, Alex.
So what we're talking about here is tax-free investments from all income taxes. We're talking federal taxes, state taxes, and capital gains taxes. So those investments are best placed in Roth IRAs, where you pay none of the taxes I just mentioned above. Now, the next one here is really interesting, though, and this is in regards to provisional income. So for those of you that are taking Social Security or getting close to taking Social Security, provisional income does include some considered tax-free investments that actually do make your Social Security taxable. Primarily what I'm referring to is municipal bonds, something that is touted as being federally tax-free, potentially state tax-free as well. That is true in terms of your interest or the income you generate off of those bonds, but it does count against your provisional income. When they calculate your Social Security taxes, your Social Security taxes may become actually taxable in that situation. So it's very, very important to know that distinction between the municipal income, but again, the Roth IRA that we're talking about, free from federal taxes, state taxes, and capital gains taxes.
So we like that tax-free, folks. That's what we're trying to do. Now, one way to leave taxable money tax-advantaged is to reposition that taxable money. Now, remember, taxable money, that's money that has interest or dividends or capital gains that year. If we reposition that over to tax advantage that Jason talked about, we could move that taxable money into a tax-deferred annuity. Now, we do that because we may be limited on how much we can move into an IRA or a 401k. There's not really a limit on moving taxable money to a tax-advantaged, tax-deferred annuity. Now, Jason, you want to talk about how that grows and when they have to pay capital gains on it, or do they have to pay capital gains on that tax-deferred annuity? Why is that tax-advantaged?
Well, it is going to change the nature of the taxability of those funds. So if you bought property in your taxable bucket and then you later sell it, you'd be subject to capital gains and capital gains rates. When you move it into a tax-deferred annuity, as it's growing, you don't have to pay any of those capital gains. If you invest it within that annuity and it goes up and you sell that position, it's still within that annuity. There's no capital gains. But when you take the income from that annuity, when you make a withdrawal out of the annuity, at that point, it's going to be taxed as ordinary income on you. So you don't have to pay any taxes until you actually take funds from the account. And that same concept applies to your family after you die.
So if you die with a tax-deferred annuity, is that a taxable event?
No, not until the funds are taken out.
So if I have a tax-deferred annuity and I leave it to you, Jason, when do you have to pay taxes on it?
When I take the withdrawals from the annuity.
So it continues to be tax-advantaged after the investor passes away. It continues to have that tax-advantaged benefit going along. Now, Alex, what is the way that we move tax-deferred funds to tax-free to make an IRA or a 401k tax-free?
So the primary way we accomplish this goal is by making Roth conversions. We're moving money from your tax-deferred IRA. You're paying taxes on the distribution to move it over to another qualified Roth IRA that we can then invest the money for long-term growth. And when those funds are distributed, either by yourself or by your beneficiaries, the assets you've converted plus all the growth over time comes out tax-free. That's the one way we do that. The other way to do that is a little bit more unique to how we plan for our clients for their futures. Is a lot of clients say, well, that's all good and well, but my kids have to take out Roth IRA money within 10 years after my passing. It eventually becomes untax sheltered, if you will. What other options are really available out there? Another option we discuss with our clients is moving tax-deferred assets into what's called a LIRP, a life insurance retirement plan. Okay, the same concept applies though, is you make distributions, you pay your taxes, you then have this bucket of money that's tax sheltered. It can grow tax deferred. If you need the money over your lifetime, you can pull out money tax free in the form of an income distribution. And at the end of the day, those assets can be then passed on to your children or other beneficiaries in terms of a tax-free death benefit.
Alex, I'm glad you mentioned that, because with the changes we've seen to the stretch IRA, the inherited IRAs in the recent Secure Act 1.0 and 2.0, I love that at Hosler Wealth Management, you're thinking about all the different types of ways to leverage these rules to best benefit your clients.
Well, also when it comes to your legacy planning, so for your children, what did you used to have? You used to be able to stretch your IRA over the lifetime of the children, and that was pre-2019. So if your children inherited an IRA prior to that year, they can use the lifetime income to take it out, a little chunk. Now it's, again, you need to take it out within 10-year period. The 2-generation legacy planning that we do for our clients allows the same concept of the stretch IRA, but now we pass it through as a life insurance benefit that your children can inherit and take a lifetime income distribution stream over their lives.
The other advantage to the LIRP, unlike the Roth, is that you have the ability to put money back in where you can't do that with the Roth. When it comes out, it loses its tax advantages.
That's right. So the Roth IRA is one of those buckets that we want clients to touch last. It's the most sacred money because it's growing. And as soon as you take it out, it loses all the benefit. If you look at the LIRP on the other side, it has the ability to take money out, put it back in, take it back out, and it does not lose its tax-free advantages. That makes it very, very, very beneficial Now, let's talk about taking advantage of the step up in basis rules, guys. That means your family can enjoy 100% tax-free money on the assets that you leave to them that qualify to be stepped up in basis. Do we get a step up in basis on Roth or tax advantaged, tax deferred annuities or IRAs? No. Those traditional IRAs, that's ordinary income always. Roth IRA comes out tax-free, doesn't get a step up in basis. It's only taxable assets that qualify for that. And one of them that I want to talk about for a second is real estate. We run into a lot of clients that have real estate investments, and they want to be able to have a tax-free move. Jason, what is the tax-free move on this type of real estate?
So there's two main ways that we see employed. Number one is that you hold that highly appreciated piece of real estate until in Arizona, one spouse dies and you can receive a step up in basis. Oftentimes though, our clients are tired of the toilets, taxes, trash, and tenants that comes with managing real estate, and they want to have mailbox money. But they don't want to pay the capital gains tax and lose some of the income that real estate is generating, lose some of the advantages like depreciation, sheltered income. So most real estate investors will be familiar with doing a 1031 exchange. That's a tax-free exchange where you go like to like from real estate to real estate, and you defer recognizing any of the capital gains. With using 1031 exchanges, you can continue to defer that capital gain, and at death, you receive that step up in basis, and your family can sell that piece of real estate and not have to recognize any capital gains or pay any taxes.
Now, Arizona is one of 9 community property states. So there's other states besides Arizona that have these benefits. But Alex, we just had a new gentleman come in and talk to us. He did not realize the community property state laws. People that have taxable brokerage accounts, we run into this all the time, Alex. They come in, they're holding it jointly. The couple has had this account. He's been managing it for 20 or 30 years. It's grown to millions of dollars. And they have it titled jointly. What is the problem there, Alex?
So the biggest problem is that at the death of the first owner of that account, only receives a step up on half of the value of that property over those assets in that taxable brokerage account. So again, people think, well, it's all community property. It should all be treated the same. It's just not the case, which is why we stress so heavily on having your trust be the owner of these assets. Well, it's a living trust. You still own, maintain, and you have control over those assets while you're alive. But at the passing of the first spouse, that spouse gets a full step up in basis to say, let's say it's $1 million. Now it's going to become tax-free. Now you can live off of that. You can let it continue to grow if you chose to. And at your passing, your estate will receive another step up in cost basis to the value of the date of death of your passing. Therefore, that asset that can again receive another step up in cost basis, your beneficiaries or your children or whoever you decide to leave your money to receive it as well as tax-free inheritance.
At the death of the second spouse, it gets another step up.
That's right.
So at the death of the first spouse. So folks, what we're trying to tell you is this. If you have a brokerage account, you do not want to hold that in your individual name. You do not want to hold that in your joint name. You want to hold that in your revocable living trust that treats those trust assets as community property with rights to survivorship. There is no brokerage account that comes that way. You have to have a trust, and you have to title that trust account or that brokerage account inside of the trust to get these tax-free benefits that we're talking about now. Let's talk about beneficiary designations, because this is part of leaving a tax-free or a tax-advantaged asset to your children, to your heirs. Beneficiary designations work on IRAs, 401ks, annuities, pensions, life insurance, 529s, and other accounts. The way we leave it to the beneficiary and whether it's taxable or not depends on the type of account it is. One point that I want to remind our listeners, we've talked about this before. If you have a traditional IRA and you die and you leave it to your children, they cannot ever convert that to a Roth IRA. The opportunity to convert that to a Roth IRA has to be taken during your lifetime or your spouse's lifetime. We just had a client passed away last year. Before the end of the year, his widow converted all of the IRA to a Roth so that the kids could be able to inherit that Roth IRA. Now, what are the other two accounts? Jason, I want you to talk about bank accounts. What do we advise clients to put on those bank accounts?
So on a bank account, you are able to place a pay on death designation. So POD, you can add that, and then the bank is notified of who the beneficiary should be ahead of time. And then on individual or joint accounts, if you're not taking advantage of using that trust registration, you're able to add a transfer on death designation that operates the same way, where you can name your primary and contingent beneficiaries. Remember, though, if you do have a marriage in a community property state, you want to make sure you're taking advantage of those community property rules.
And the pay on death, one of the things that I want to remind our folks about, what are the type of accounts that we use that on? And primarily, it's the primary checking account, folks. You have it jointly between a husband and wife. You put the POD on there to make sure that that will transfer to the kids, not being subject to probate, because that could be very expensive. You might keep $50,000, $100,000. It might be a probatable account. You avoid that by putting the POD on your checking account. Jason mentioned the TOD there. Alex, we run into this with people. Maybe they have an individual account. They're not married anymore, and he's trying to leave it to the kids. They can add a TOD on there. And then on joint accounts, they can do that as well. But that doesn't give us the step up in basis that we're after, does it?
It doesn't. It doesn't. So again, going back to the whole concept of using a trust for this specific purpose, when you have joint situations, is highly crucial, again, from a tax planning perspective of getting the full step up. So that way your beneficiaries can enjoy tax-free inheritance.
Glad we came back around to the beneficiary designations at the end here, guys. We've talked about this in previous episodes in this series. And no matter what you say in a will, the bank or the custodian of this account is going to look at those POD or TOD designations. No matter what you walk in with, they're going to go with their records in most cases. So it's really, really important. I'm glad we hit on this today.
Yeah, and everything we've talked about today avoids probate pretty much. And that's really one of the goals that's just as important as tax advantaged or taxable or tax-free.
All right, guys, if anybody listening wants to talk to you and the team at Hosler Wealth Management regarding these issues or anything regarding their financial future, how do they best find you?
Well, of course, they can reach us on the web at hostlerwm.com. How about up in Prescott, Jason?
In Prescott, they can call our office at 928-778-7666.
Alex in Scottsdale?
480-994-7342.
All right, gentlemen, we'll be back to talk part 5 of our series about charitable giving and charitable legacies. We'll talk then.
Thanks, John.
Thank you, John.
Bye, John.
Securities and advisory services offered through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Forward-looking commentary should not be misconstrued as investment or financial advice. The advisor associated with this podcast is not monitored for comments, and any comments should be given directly to the office at the contact information specified. Any tax advice contained in this communication, including any attachments, is not intended or written to be used and cannot be used for the purpose of 1. Avoiding federal or state tax penalties, or 2. Promoting, marketing, or recommended to another party any transaction or matter addressed herein. The accuracy, completeness, and timeliness of the information contained in this podcast cannot be guaranteed. Commonwealth Financial Network does not provide legal or tax advice. You should consult a legal or tax professional regarding your individual situation. Accordingly, Hosler Wealth Management, LLC does not warranty, guarantee, or make any representations or assume any liability with regard to financial results based on the use of the information in this podcast.